Well, we're thrilled that you're here. Wow, what is juicing the markets right now? What did he say? We had our opinion. What do you think it was?
I think what he said was that the actual interest rates are very close to the neutral rate. And the market loved that because it meant no more increases in interest rates.
In fact, he said just below.
Just below. But what does just below mean? The Fed has said the last time they met, they said they're aiming for 3+ for the federal funds interest rate. So it's now 2 and a bit. So that sounds like just 1 percentage point. But that's a big move. And so it's hard to believe that he's really calling that back and saying we're not going to 3+% for the federal funds interest rate.
Well, because it was October 3rd, he said we're a long way away from neutral, and then suddenly he switched. Why do you think he switched?
I have no idea.
The data look good, Marty.
I don't think he really switched. I think the market is overinterpreting that phrase. Remember, he also said in this speech that this so-called neutral rate is a very uncertain number. We're not sure where it is. It's not locked in concrete. So I think that they're not going to come out when they come out with the next set of forecasts. I don't think they're going to come out saying that it's not 3+.
Do you see any reason that Jerome Powell and the Fed should not raise rates next month in December?
I mean, there are reasons, but I don't think they're persuasive. I think the Fed should keep raising rates. I think the Fed should have started raising rates, as you know from our conversations in the past, should have started raising rates several years ago so that they would have the ammunition when the economy turns down. And I think that's what's driving the Fed now.
We in the newsroom could not believe that no one asked him about President Trump and the public excoriation the president has put out there about Jerome Powell. In fact, just yesterday, he gave the Washington Post an interview where he said, so far, I'm not even a little bit happy with my selection of Jay, not even a little bit. Do you agree or disagree with the president's action in the way he has criticized Jerome Powell?
I don't think it has any effect on the behavior of the Fed. I think that the president is making sure that when the economy turns down, he'll be able to say, well, that's what did it. The Fed did it. I didn't do it. And so I think it's just looking for a scapegoat.
Is it true? Would that be true, that it would be the Fed's fault? I mean, don't recessions happen every so often?
Yep, but you need to have a story. And the president, I think, wants a story, and he wants to tell his base that, and they don't like rising interest rates. It hurts car sales, it hurts mortgages, it raises a lot of rates. A lot of mortgages are floating rate. So he's saying, I'm on your side. I don't want rates to go up.
Well, what do you think about that? Do you roll your eyes and say, I mean, really, or do you say, well, he's right, the Fed shouldn't raise? I mean,
no, I think
the Fed should raise.
I think the Fed should raise rates. I said that in the Wall Street Journal on Tuesday. I think that that's what the Fed ought to be doing, because I think when the economy turns down, as it will, we need to be able to have a reduction in interest rates, and only the Fed can do it if they have a high enough rate.
Marty, we have a trade war right now with China. We see a goods deficit with China widening, not shrinking as the president would have wanted. We have Brexit and that big question. We've got the G20 coming up, all kinds of issues. Which one of those, do me a favor, try and pick one, has the strongest potential to trigger a recession?
Rising long-term interest rates causing the stock market to turn down.
Well, you just said that the Fed needs to raise rates and that it wouldn't be
long-term rates, I said. Long-term rates. So long rates are going to go up because we are seeing a little bit of increasing inflation, because we're seeing a massive fiscal deficit, and the Fed is going to move up gradually at the short end. But I think right now the 10-year Treasury is little over 3%. In real terms, that means it's about 1%. To normalize means it's got to get up to about 5%. So I think that's when that happens, I think the stock market's going to be unhappy.
Okay, we have to run, Marty. Thank you very much. It's such a busy day. We appreciate you coming straight from the luncheon here. But overall, good speech, rate it.
Oh, it was a good speech, but and he was very careful not to criticize, not to rock the boat, not to criticize the past, not to say that markets were overpriced. But I think they are overpriced.
Aha! There he saves the headline till the last second. Martin, thank you very much.
Good being with you, Liz.
Martin Feldstein. I've got my tickets in hand, and I'm heading straight to the airport, off to Argentina after the show to cover the G20 for the Fox Business Network. I'll be reporting live from the sidelines and hosting Countdown from Buenos Aires on Friday. Don't miss it.